Okay, welcome back everyone and good afternoon. Today we're going to be talking about trading debit versus credit vertical spreads. My name is Tony Zhang. I am the chief strategist here at Options Play, and today we have a webinar that we've done once before, but I want to touch up on this subject again because we have some new research to present to you guys about some of the optimal best practices when it comes to trading debit versus credit spreads. This is two of my favorite strategies when it comes to trading options because it allows you to take a directional view regardless of what that directional view is. Both debit and credit spreads really allow you to take that directional view, but most importantly with limited risk. And that's really one of the key interest as to why I trade options, is because at the end of the day, we don't have a crystal ball. We have some guesses as to where we think the market's going to go based on different types of analysis that we do, and we want to be able to leverage that into strategies that give us the maximum return for our views, but also at the same time limiting our risk. So debit and credit spreads allow us to take whatever views we have in the markets and really try to profit from that. But they are two very, very different strategies. So I want to take the time out today to make sure that everyone understands the differences between the two, understands how to construct the difference between the two, but more importantly, know that once you have your views on the underlying stock, which one is actually the right strategy to implement. So we'll go over all of those details here today, and then we'll have some real examples to show you using Options Play, the tool that you guys all have access to actually start implementing and start analyzing some of these strategies. So this webinar is recorded. For those of you that are brand new, welcome to Options Play. We will send out the recording with the slides in about 30 minutes after we wrap up today, so that not only do you have the recording, but you can also follow along with us using the slides. And if you're a first-time user, the slides will have some important links. So specifically, I have actual webinars on debit spreads and credit spreads. Today, we're going to talk about the differences between the two and how to utilize them, or how to tell the difference and so when you should implement them. But we do have specific ones on how to trade debit spreads and how to trade credit spreads. And a lot of those links are in the webinar recordings, links to our daily trading ideas, as well as how to start your subscription and follow us on YouTube. Important links to follow along if you're using this for the first time. So today what I'll go over is, number one, what are vertical spreads for those of you that are brand new to this strategy. I'll talk a little bit about when you should use vertical spreads. Very, very important, because it is very different criteria as to when you should use debit versus credit spreads. A lot of people like to try to compare a debit spread to a credit spread, but in reality, you probably shouldn't be comparing them at all because they're utilized in completely different use cases. So once we've identified what those different use cases are, I'll talk a little bit about the best practices as to how to pick expiration dates and strike prices based on our backtesting for both debit spreads and credit spreads, and then how to manage them effectively. So once you're in a debit spread, once you're in a credit spread, how do you decide when it's time to take profit, when it's time to cut losses? Those are the things that we'll go over here today. And then lastly, what I really want to make sure that you guys focus on today and make sure that you leave this webinar with is knowing how to actually use our tool Options Play to analyze debit and credit spreads. That's the most important piece, because it's one thing to understand it from a conceptual perspective. It's another thing to actually be able to analyze it and trade it yourself. So that's why I really want to I love doing these webinars to show you guys how to utilize the tool, because then you become self-sufficient in using these tools to start doing your own trading, and you don't need to rely on us all the time to help you with ideas and trading. You can go out on your own and start finding ideas and start trading them on your own. So before I get started, I just want to launch a quick poll here. I just want to get an idea as far as, for those of you that are trading vertical spreads, what do you prefer trading? Do you prefer trading debit spreads? Do you prefer trading credit spreads? Or do you like trading other types of strategies? I just want to get a feel for who's in the room here. So it looks like debit and credit spreads are pretty closely tied. Looks like credit spreads got a few more users interested in using credit spreads versus debit spreads, which is expected. Generally speaking, credit spreads seems to be the more popular strategy, but I want to make sure that you guys are utilizing it correctly. I tend to see some users just always trade credit spreads, or some traders always trade debit spreads. But in reality, they're very different strategies, and they should only be deployed in certain market conditions. So we'll go over what those things are. So as you can see, 50% of you like to trade credit spreads, about a third of you trade debit spreads, and then the rest of you trade other strategies. So let's go ahead and start off with talking about what are vertical spreads. Let me see if I can remove this poll here. So what are vertical spreads? So vertical spreads are very simple. These are two-leg option trades that on the same expiration date, and you can combine them into debit and credit spreads. So on the bullish side for debit spreads, we have the long call vertical, and on the bearish side, we have the long put vertical. And I changed these recently because of some feedback that people sent me on some of the previous webinars, saying that the terminology we had on our slides were different from the terminology we had on our platform. So I wanted to make sure that everything was consistent. So if you're trading a debit spread, it's a long call vertical, a bearish spread is a long put vertical, and the credit spread is basically the exact opposite. The bullish trade is actually the short put vertical, and the bearish trade is actually the short call vertical. Okay, so you don't have to, this might be a little confusing, but we're actually going to talk in the next slide how each one of these are constructed. But effectively, a debit spread is a trade that requires a debit to enter the trade and a credit to exit the trade, and credit spreads are the exact opposite. You get a credit to enter the trade, and you have to pay a debit to exit the trade. But from a trading perspective, they're both relatively simple to understand. They're both very simple to really analyze your max risk and max reward. So let's talk about what are vertical spreads and why people like to trade them. So by far, the number one reason why people like to trade vertical spreads is the fact that you have predefined risk and reward before you get into a trade. When it comes to trading anything, it's always good to know what your potential outcomes are before you get into a trade so that nothing is a surprise to you. And when you're trading vertical spreads, you know what your max risk is, you know what your max reward is, and it's relatively simple to calculate when you'll hit your max reward, when you'll hit your max loss, and where your break-even price is, because vertical spreads are fairly straightforward from that perspective. So what I'm going to do is I'm going to talk a little bit about the construction of debit and credit spreads. You don't have to memorize this. This is really just for illustrative purposes for those of you that are relatively new to this strategy. Our platform actually constructs all of them on your behalf, so you don't have to know how to create them. But I do want to create for illustrative purposes. If we're talking about stock XYZ that's trading at $100, I want to talk about how to construct a debit spread and how to construct a credit spread. So let's talk about debit spread first. So we're talking about a debit spread when we're talking about a bullish trade. So meaning we're talking about stock XYZ, it's trading at $100. We're bullish on the stock. We think it's going to go higher. What can you do? You can trade a long call vertical. That's where you're buying a 100 strike call, so an at-the-money call. And at the same time, what you're going to do is you're going to sell an out-of-the-money call. You're going to sell a 110 call against it, a further out-of-the-money call. And what that does is it offsets the cost of that long $100 call. It helps reduce your overall risk from an outright buying and just a $100 call. And what it does is that since you have one short leg, that short leg is going to have theta working in your favor as opposed to the long leg where theta is working against you. So it kind of self-offsets each other, which allows you to stay in a trade a little longer compared to if you were just bought the long call. On the put side is the exact opposite. So pretend we're trading stock XYZ that's trading at $100. Let's say we're bearish on the stock. We think it's going to go down. What can we do? So trading the long put vertical is you're buying that $100 put. This is the at-the-money put. This is what you would traditionally do if you were just outright buying a single leg option. You buy put because you're bearish on the trade. But what we're going to do here on a debit spread is we're going to add to that. We're going to sell a $90 put against that. Again, by selling that $90 put, we're going to receive some income, which offsets the cost of buying that $100 put. And the same thing, it reduces the overall risk, lowers the break-even price, and also at the same time reduces the time decay on the overall trade, which allows us to potentially stay in that trade a little longer than we normally would if we just bought the put option. So that's a relatively simple strategy. Debit spreads are one of my favorite strategies because they're really simple to construct, they're really simple to understand, and they're relatively simple to manage as well. Those are all the things that I typically look out for when I'm trading options. So now let's take a look at credit spreads. Credit spreads is similar to this, but it's the exact opposite. So if you're bullish on a stock, we're going to talk about the short put vertical first. So if, let's say we're talking about stock XYZ, it's trading at $100. Now, if we think we're bullish on the stock, we think it's going to go higher, what we can do is we can sell the $100 put first. And for that, what we're going to do is that puts unlimited risk to the downside if the stock goes any lower, but it profits if the stock goes higher. So in order to offset that unlimited risk, what we're going to do is we're going to buy back a $90 put, a lower put. What that does is just caps our risk so that we don't have maximum risk all the way down to zero if the stock goes all the way down to zero. Conversely, if we're bearish on stock XYZ trading at $100, we can sell a short call vertical. That's where we're selling a $100 call. This leg will make money as long as the stock stays below $100. But in case the stock does go higher, we have unlimited risk to the upside. So in order to cap that risk, what we do is we buy a 110 call against it, and that caps our risk so that we have a defined risk. So both of these trades, again, very different strategies, but both have predefined risk and predefined rewards so that you know exactly what you're getting yourself into. And you know at what point should you expect your maximum return and when you should expect your maximum loss, so that you already have a view in your head. So in the future, as the stock goes higher, the stock goes lower, you have an expectation of, am I going to make money? Am I going to lose money? That's really one of the key differences between trading vertical spreads than just outright buying a call or a put. Sometimes when you buy a call or a put and the stock goes up by $5, you may not know how much money you're going to make or how much money you're going to lose. With the credit spreads or the debit spreads, they are much easier to calculate from that perspective. And in my opinion, when you have that type of outlook ahead of time, it makes it a little easier to manage this trade from an emotional perspective, because you already have a good idea as far as what you can expect from each one of these strategies. So now that we've talked about how to construct a debit and credit spread, what I wanted to share with you guys is some of the backtesting results that we've seen trading different debit spreads, different credit spreads, to give you an idea as far as where we find the best expirations and strike prices, or best practices for choosing expirations and strike prices. Now, this is by no means what we're telling you that you have to do, but this is usually a very good starting point if you're starting out with trading debit spreads or trading credit spreads. And again, you don't have to memorize this. We will send this out to you in the slides afterwards so you have this as a reference. But when it comes to trading debit spreads, the first thing we found when it comes to trading expiration dates is that you generally want to go at least 1 month out. You want to, if you're buying an option, if you're trading debit spreads, and we think of debit spreads as being long options, and we think of credit spreads as being short options because of the theta. So when we're going long options with the debit spread, we generally want to minimize theta. And the only way to do that is by buying expirations that are at least 1 month out. So we usually like to go closer to 2 months out when we're trading debit spreads, because when you're trading debit spreads, you want to get into the trade and you want to exit before expiration. So during that time, you want to make sure that you're minimizing theta, and the only way to do that is by trading with longer dated options. And what we generally find is that when you're trading debit spreads, that you're best to be long options that are just about the at the money strike, so anywhere around a 50 to 60 delta, so either at the money or slightly in the money for the long leg, and then the short leg should be somewhere roughly about a 10 to 15 delta, so a fair distance away from the current price. A 10 or 15 delta really has a relatively low probability of the stock hitting those strike prices, but it also still brings in enough premium to offset about 10 to 20% of the long leg, which is a significant reduction in risk. If you can reduce every single trade's risk by 10 to 15%, that will help increase your overall returns. And not to mention also lower your overall risk in total. So those are the general best practices that we find when you're trading debit spreads. When it comes to credit spreads, it's a little trickier. It's not as simple and straightforward, because credit spreads, you have to think about the credit in respect to the total risk that you're taking on the vertical spread. So you can choose the distance between the two strikes, and then you can also choose the distance that the two strikes are away from the current price. So there isn't a really good rule of thumb here, But what we generally teach is that you want to receive the credit you receive on a credit spread should be roughly about a third of the width of the vertical. And when I talk about the width of the vertical, it's simply the distance between the two strikes. So when we talk about selling a 110 call and selling a 100 call and then buying a 110 call, that's a $10 width, because that's a distance between the sell leg and the buy leg. Same thing on the put credit spread. If we're selling the $100 put and buying the $90 put, that spread has a $10 width. So we want to collect roughly about a third of that width. So if you're selling a $10 strike, you want a $10 strike width, you want to collect about $3.33. So that's really the rule of thumb that you can use that allows you to fiddle around with the different strikes and get to roughly a third of the width. And what we find with credit spreads is that it's best to sell very short-dated options. So you're almost always selling credit spreads that are less than 1 month from expiration. A lot of credit spreads are sold 2 to 3 weeks out from expiration. That's the crux of where we see a lot of credit spreads are traded. And you generally want to sell a slightly out-of-the-money call option, a slightly out-of-the-money option to start with. So roughly a 40-45 delta is a good place to start on the short leg, and then the long leg is usually somewhere around a 20 to 25 delta. Again, when you're selling credit spreads, a lot of people have different views on how they like to sell credit spreads. Some people like to sell credit spreads that have 95% probability of profit, which means that they have a very high probability of profit, but you also have very, very poor risk to reward in that 5% chance that the market does move against you. You end up risking a lot more money than the credit you've received. I'm generally not a fan of doing that, and our backtest shows otherwise too. Our backtest shows that those types of strategies, those very, very high probability strategies, do not work very well in the long run, because all it takes is 1 or 2 bad weeks and you're wiping out months and months of profits, versus credit spreads that follow this type of rule where you're receiving about a third of the width of the vertical. You're much less likely to wipe out, a few months worth of work just from a few bad weeks. So that's based on our back testing, some of the things that we wanted to share with you that's new to this specific webinar that we've never done before in the past. So now that we've looked at kind of how to construct them, what are some of the best practices, what I really want to dive into is the difference between the two, right? Because so far we've just talked about the construction, we've talked about how they're different from a trading perspective, but how are they really different from your perspective in deciding exactly which one to implement? And before we can get into that, we will have to first understand the relationship between risk reward and probability. That's really one of the most important relationships that people have to understand with all forms of trading, not just options trading, because all forms of trading is a trade-off between risk reward and probability. So when you're trading debit spreads, these types of strategies tend to be lower probability of profit, but better risk to reward or higher risk to reward. So what a typical debit spread looks like is, you have about 40% of your trades are winners and maybe 60% of your trades are losers, but you have a very high risk to reward, meaning you're typically risking a small amount of capital to try to make a large amount of capital. And we'll show you some real examples of this, and we'll put the two side by side to make this a little bit more clear. When you're trading credit spreads, it tends to be the exact opposite. You tend to have relatively high number of winners, so maybe 80% of your trades are winners and only 20% of your trades are losers, but you are risking substantially more money to do that in order to try to make a smaller reward. And there's nothing you can do about it. That's just the relationship of trading. And what you have to do is try to find an edge in your signals, find an edge in how you manage, how you predict the markets. That's going to provide you with that edge. But the overall market is always going to provide a relationship between risk reward and probability, and you can always find high probability or low probability, but you're always going to find that trade-off is going to be that risk reward. So it's really important to understand the difference between the two. It is psychologically two very different strategies. One where you're winning all the time, but when you lose a lot of money, and the other one where you're losing most of the time, but when you win a lot more money. So psychologically, those are two very different strategies, and it's really important to understand that before you get into that type of trading, because a lot of people will say, well, I just want to win all the time. And that's great, and that you want to win all the time. Everyone wants to win all the time, but are you okay with that one loss wiping out, the past 5 or 10 trades that you've made. Some people aren't okay with that. I'm certainly not as comfortable with that. I much prefer risking less money to try to make more reward, but other people feel differently. So figure out kind of what suits you perhaps, and that will also help drive which type of strategy may be best suited for you. So when we're talking about debit spreads, this is really what it feels like to be a debit spread trader. You're going to have less winners but bigger rewards. So here I have an illustrated 5 trades where I'm winning on 2 trades. I'm winning $100 on 2 of those trades, but 3 trades where I'm losing $50 each. And the net result at the end is I make a $50 profit at the end of these 5 trades. And on a credit spread, what I have is just a slightly different risk reward and slightly different probabilities where I have 4 winners. Each one of them I'm winning $50, but I have 1 trade that I lose $150 on. And my net result is still the same. I still make that $50 profit at the end of the 5 trades, but it's just a different path to that same $50 reward. So it's not like one strategy is better than the other. It's just a different path to what I consider relatively similar ends, if you will. So just making sure that you understand the difference between the two and understand from a psychological perspective, they are quite different. Really important to understand before you decide which strategy is best for you. So now that we've discussed the trade-off between probability and risk reward, I really want to tackle when is the right time to use these vertical spreads, because this is really the crux of how do you decide, should I trade a debit spread or should I trade a credit spread? For those of you that have experience trading both debit and credit spreads, you may have used other services that tell you that you should sell credit spreads when implied volatility is really high, or you should use debit spreads when implied volatility is very low. But I will argue against that the edge that you have in implied volatility is relatively small compared to when is the right time to use these two strategies. So what we always teach users is that if you expect a large and quick move in one direction or another on any stock or ETF, your best trade is always going to be a debit spread, regardless what the IV or implied volatility of that stock is. And the reason for this, and I'll make this very, very apparent once we put the two side by side using options play, as to why that is the case. And I'll even show you the numbers as to even when implied volatility is really high, why debit spread still is going to give you the better return if you expect a large move in the underlying stock. So this is generally speaking good for those of you that are technical analysts, that you're looking for breakouts or breakdowns, or a stock rebounds off of support and resistance, or you're expecting a quick and fast move in one direction. Always use a debit spread. They are generally better in lower volatility environments. That is true. However, that does not mean that you can't trade them in higher volatility environments. And I think that's the key distinction of what I want to teach. Conversely, on a credit spread, this is really useful when you expect a neutral or modest move. So if you don't expect the stock to move very much, but you certainly think that it's not going to move in one direction or another, which is very popular amongst those of you that use technical analysis and use oscillators. So if you use MACD, RSI, stochastics, please type them into the chat window. I'm curious as to what type of indicators you guys use. You know, if you use stochastics or MACD or RSI, please type them into the chat window, because these are the types of indicators that are really good for credit spread traders. Because once you've identified a stock is overbought or oversold, and you think the stock's not going to continue going any higher because it's overbought, or you think it's not going to go any lower because it's oversold, then these are the optimal times to use credit spreads, because these trades don't necessarily end up in big moves. They just tell you statistically that the stock is unlikely going to move in one direction or another. And again, it is very true that credit spreads are better in higher volatility environments, but I will show you why, even if you are in a lower volatility environment, you can still very much trade credit spreads, okay? So making sure that we understand the difference between the two. Debit spreads, generally speaking, for those of you that are using charting and identifying breakouts, breakdowns, support and resistance, rebounds, or retest of support and resistance. These are the chart, reading a chart, if you will, and credit spreads is more so for indicators, overbought, oversold, all of these indicators that you guys just told me, RSI, MACD, support. So MACD would be a good example of credit spreads. RSI, CCI. So these are all great for credit spreads. And for those of you that said support and resistance, those are better for debit spreads, okay? So making sure you understand the difference is really, really important. So here's an example of when it might be time to use a debit spread. So we've identified a chart pattern here. In this particular case, it's a triangle. And it's a triangle, it's a big triangle that got smaller and smaller and hit an apex. And eventually that stock broke above that triangle to the upside. So these types of moves, we would expect a big, fast, quick move in one direction or another. So those are the types of times that you would want to utilize a debit spread for. Conversely, for those of you that are using oscillators like the stochastics indicator at the bottom, whenever you've identified a stock is oversold like it is here near the support level, that would be a time to consider selling a put credit spread. And then when the stock hit that top of that range in that stochastics, that would be a time to consider selling a call credit spread. And then as the stock oscillates between overbought and oversold, you can continue to string put credit spreads and to call credit spreads, to put credit spreads, to call credit spreads, and you can do it over and over again. So one of the key differences I think that's very different about trading debit versus credit spreads is that it's more likely that you will trade debit spreads on different stocks all the time, because you only identify these breakouts at certain times. Versus if you're selling credit spreads, it's likely that you'll sell the same credit spread on the same, or you'll sell credit spreads on the same stock over and over again. So that's another distinct difference between trading debit spreads, is that as a debit spread trader, you're always looking at different charts because you're always trying to find a stock that's going to make a big move. Versus credit spread traders tend to trade the same stocks over and over again. So very, very different mentality as well from that perspective as well. So again, trying to just educate you guys on the differences between the two and what it feels like to trade debit versus credit spreads, because again, they are very, very different strategies. Really important to understand the difference before you start trading them. So now that we talked about construction, talked about best practices, talk about when to utilize them, once you're in a debit spread, once you're in a credit spread, how do you actually manage it? So with both strategies, risk management is absolutely key. The entry with debit spreads is really, really simple. You enter them when you expect a large move. So if you expect a breakout to the upside or a breakdown to the downside, or a stock bounces off support and resistance and you expect a big move in one direction, that would be the time to enter a debit spread. And one of the reasons that I prefer to trade debit spreads, simply because I don't have the time to look at my portfolios all day long and manage every single position all day long. Debit spreads tend to be a little easier to manage because the rule of thumb to when you should cut losses and when you should take profits are really, really straightforward. It doesn't matter what strikes, what expiration. It's generally all the same. It's the same rule. And debit spreads is a strategy that you typically want to cut losses or take profits before expiration. The goal is to always exit before expiration, either at a gain or a loss on a debit spread. And the rule of thumb here for exit strategies is to simply cut losses if the move that you're expecting does not materialize. Meaning if you're expecting a breakout and the stock kind of breaks out but then doesn't really follow through, you're not getting the move that you're expecting, cut your losses, move on. And the rule of thumb is that if it doesn't really hit any target or it doesn't go against you enough, the rule of thumb to cut losses is that if you've lost more than 50% of what you've paid for the premium, that's a good time to consider cutting your losses and moving on to the next trade. This is the type of rules that we follow with the daily plays that we send out. The daily plays that we send out are new ideas on new stocks every single day. We always use a debit spread, and these are the rules that we use to manage those debit spreads. And lastly, to take profits, we usually like to hit about a 75 to a 100% target gain in order to take profit. So this is really, really simple. So if you pay $1 for a debit spread and it's down to 50 cents, time to cut losses. If it's now trading at $1.75, $2, that's when it's time to start taking profits. And it doesn't matter how much you've paid for a debit spread or what type of debit spread you trade. These are the very simple rules that you can apply for managing your debit spreads. When it comes to trading credit spreads, it's a little bit more involved. So for those of you that are trading credit spreads, I do suggest that you have some experience trading debit spreads before you get into credit spreads, because it does depend on what type of credit spread you trade. But to get into a credit spread, you want to time them with tops and bottoms. So when you've identified a stock is oversold or overbought with any of the indicators that you guys have put into the chat window, Once it's overbought, time to sell a call credit spread. Once it's oversold, time to sell a put credit spread. And you can string the put and call verticals together, meaning you don't have to wait for a call credit spread to expire before you enter that put credit spread. So in the example I gave here before, you could have sold a call credit spread up here and a few days later sold a put credit spread, even though the call credit spread that you sold up here has not expired yet. As long as you have the capital to do it, you can continue to string calls and puts together. As long as you feel the stock's going to trade within a range, you can do that. And that's one of the beauties of selling credit spreads, that I will say that that's what attracts a lot of people to that strategy, is because you can do it over and over again on a stock or an ETF that you're very familiar with, and people are comfortable doing that. And if that's what you like, please, by all means, I just want to make sure that you guys are utilizing the strategy appropriately. So when you're selling credit spreads, the overall goal is to sell a call or a put credit spread for the credit that you receive. And the goal is to simply let that credit spread expire worthless so that you keep all that credit. That's the goal here. However, obviously that doesn't always go our way. Sometimes stocks goes in the opposite direction that we expect it to. So the rule of thumb as to when to cut your losses on a credit spread is a little different, because it depends on how much premium you received with respect to the vertical width. Vertical width, again, is the distance between the two strikes, between the strike that you bought and the strike that you sold, and the premium that you receive with respect to that. If you're receiving more than 20% of the vertical width in that credit, then you want to cut your losses when you've reached about 75 to 100% loss on the trade. So if you've received a $1 credit on, let's say, a $5 wide trade on a $5 wide spread, and that credit is now trading at $2, so you've lost a full 100% on that trade, it's time to cut your losses and get out. If you receive less than 20% of your vertical width, and this is for those of you that are trading those higher probability credit spreads that have 85, 90% probability, you're going to collect much smaller than 20% of the vertical width. For those of you that are selling these way out of the money credit spreads with high probabilities, where your premium that you receive is less than 20% of the vertical width, you want to cut your losses when you've reached 100 to 200% losses on the trade that you've sold. So if you've sold a $10 wide credit spread and you've received $1 in credits, then you want to wait till you've lost about $2 to $3 on that trade before you start cutting your losses. Because you've received such a small amount in relation to the full credit spread, you can give yourself a little bit more room to lose money before you decide to cut your losses on that trade. So credit spreads is a little bit more involved. If you do stick to the same strategy over and over again, then you simply just have one set of rules to stick to. But if you're selling some credit spreads that are further out of the money, that have lower amounts of premium, and you also like to sell credit spreads that have higher amounts of premium, you just have to make sure you account for the two differently from each other. So there are different rules here. Making sure you understand that is really important to helping you manage these trades effectively. So credit spreads, again, a little bit more involved than debit spreads. The rules for debit spreads are a little simpler, but making sure that you guys understand the difference between the two is the most important thing for this webinar. So with that, what I want to do is actually bring up options play and show you some examples of the two. I want to put the two side by side. I want to go through some examples where you could potentially go either way and show you how the strategies will actually perform. So I'm going to start off with Goldman Sachs today. And I don't have any particular views particularly on Goldman Sachs, and I'm using this stock simply for illustrative purposes. This is by no means a solicitation or a recommendation to trade Goldman Sachs, but this is a stock that I found interesting because 240 was a resistance level that it kind of hit for quite some time for the last few weeks. As you can see here in late August, it hit 240, bounced lower, hit 240 again in early August, bounced lower, and hit 240 again in late August and bounced lower. And just a few days ago, finally broke above that level. This is a stock that's relatively weak at the technical score of 4, so telling me this is a weak stock, but the trends have started to turn bullish. And it turned bullish as the stock broke above that 240 resistance level. So this is, if you're a technical analyst and you like to read charts, this is a pretty clear indication that 240 was a resistance level, broke above it, and starting to came back down to test that 240 level. So there's two ways that I think a technical analyst can read this. You can either say 240 is a pretty strong support level. I definitely think it'll probably hover around 240 and maybe move a little higher. I don't know. It's a relatively weak stock. I don't know it's going to make a huge run higher, but I'm pretty sure it's not going to go below 240. The other way you can read this is that, hey, this is retesting 240. This is definitely going to rally higher to 250, 255 or higher. So both of those are in my opinion, correct interpretations of the chart as a technical analyst. The question is just how bullish are you on the stock? And either, depending on how bullish you are, if you think the stock's just going to hover around 240, that would be better for selling a credit spread. If you do think it's going to bounce off 240 and really take off, 250, 260, that would be better for a debit spread. So I want to put up a credit spread next to a debit spread and show you guys the two, how you would analyze it, and really show you how little impact implied volatility actually has on some of these strategies. And hopefully that will help change or shift your mentality when it comes to deciding, should I trade debit versus credit, by looking at the underlying and not necessarily focusing so much on implied volatility. So Goldman's trading at around 240 right now. By default, options play will always show you three strategies. You'll see buy stock, buy call spread. And the spread here on the right will always be that debit spread. And we've actually optimized it based on those parameters that we told you. We're always looking at roughly about 45 days out because we want to go at least 1 to 2 months out, where there's plenty of liquidity, not too far out, but also minimizing theta. And we've identified strikes. So, the slightly in the money strike, we're buying the 237.5 calls and we're selling the 255 calls, which is roughly about 1 standard deviation away. So the debit spread is always optimized for you for a bullish or bearish move on any given stock. Then what I'm going to do now is I'm going to modify this call. I'm going to change this to a credit spread. I'm going to show you these two strategies side by side. So we can use our strategy constructor, which you can use to say I'm bullish on Goldman Sachs, and we know the short put vertical is the bullish strategy for a credit spread. And what I'm going to do is I'm going to sell a shorter dated option. We talked about selling, less than 1 month out. So I'm going to go out to the September expiration. I'm going to look at, let's say, a $5 wide strike. And what I'm going to do is on a $5 wide strike, I want to collect about $1.66 or so. That would be a third of the width of the spread. So if I'm talking a $5 width, I want to collect roughly about $1.66. So that's either the 240, 235 vertical or the 237, 232.5, which is $1.39. So that's a little lower than I want. Though 240, 235 may be a little bit more appropriate. It's a little bit more than $1.66. I'm getting $1.87 here. So you can play around with these. And this is really where credit spreads, there's a lot of you can play around with it a lot. So for example, you can also go to $7.50 strike. So a third of that would be 250. So maybe let's take a look at this. So a $7.50 strike, 232.5 by 240 credit spread. I'm collecting exactly a third, which is what I'm looking for. And what I'm going to do now is I'm going to compare the credit spread that we've just constructed here to this debit spread that I was looking at here. Now, in order to compare the two side by side, what I first want to do is making sure that we compare them apples to apples. So first, what I'm going to do is I'm going to say I'm willing to risk, let's say, $2,000 on this trade. So if I'm willing to risk $2,000 on this trade, I can sell 3 contracts of the credit spread and I can buy 2 contracts of the debit spread. So as you can see here, I'm risking $1,500 here in total on 3 contracts, and I'm risking $1,300 on the 2 debit spreads. So roughly same amount of risk. Maybe let's go to $2,500. So if we go to $2,500, I can sell 4 contracts of this and 3 contracts of this. So both of them have roughly exactly the same amount of risk, $2,000. So let's compare the two side by side. So first of all, Goldman's trading at 240 right now. Like I said, there's different views on this. You can think that Goldman's just near its support level. It's just going to sit around here and not really move a lot. And if that's the case, you can say, well, what happens if Goldman stays at 240? So Goldman stays at 240 between now and the expiration date, which is September 21st of this strategy. As you can see, you're going to make $1,000 profit. You're going to make $1,000 on this $2,000 risk on this strategy. And if you bought the debit spread, you actually lose 25%. So right off the bat, as you can see, if you expect the stock to stay where it is, you think that 240 is the support level, it's not going to go any lower, it's just going to stay where it is, then clearly the credit spread is the trade to make. Regardless of where implied volatility is, that it goes higher, goes lower, as you can see, the impact to your returns is nothing Even if we're before expiration, even if implied volatility goes much higher or much lower, the impact to your returns is relatively small compared to how much money you would make or lose on the strategy itself. So as you can see on September 21st, most of your money is actually coming from theta. So as you can see, between September 20th or between September 19th and September 21st, you're making almost half your profit in those last 2 days. So theta is really where most of your exposure is. And this is really where our platform teaches you the concept of delta using this price slider. We teach you the concept of theta using this time slider. And we teach you the concept of vega, which is volatility, using this volatility slider. And this is really designed so that you don't have to calculate delta, theta, and vega on your own. This does all those calculations for you. So you can say what happens if the stock stays exactly where it is and time goes by a certain number of days, how much money should I expect from my strategy? So as you can see here, if the stock stays exactly around 240, this credit spread clearly is a trade to make, and the debit spread will actually lose you money. So if you expect the stock to trade where it is, don't trade the debit spread, even if volatility is really, really low. And this is really why we teach, don't use volatility to decide should you trade debit or credit. Base it on where your views are on the underlying stock. Because if you thought that if you thought Goldman was bullish and implied volatility is really, really low, so you chose to trade the debit spread, as you can see, the stock you're not going to make any money if the stock stays where it is. But if you think the stock's going to go any higher, as you can see, if the stock goes up to roughly 248, which is $8 higher, a decent move higher, but not a whole lot. It's only up to here, which is roughly the same amount of move that it made over the last few days, from about 234 to 245. So it made about a $10 move over the last 3 days. It's not crazy to think Goldman can make another $10 move higher. So as you can see, if the stock moves another $10 higher, this debit spread will actually give you the same amount of profit as this credit spread. And you can use this slider to say, how far do you think the stock's going to go? Do you think the stock's going to go to 255? If you do think it's going to go up to 255, as you can see, this strategy is still always going to make you a $1,000 profit. You're not going to make any more because of credit spread. You're only going to realize the maximum reward no matter where the stock goes, or if the stock goes any higher, you're not going to make any more money. On a debit spread, you are going to substantially make a much higher return. So here, instead of making $1,000, I'm not going to make $1,900. Even though I'm risking the same amount of money, I'm risking $2,000 on this trade, but I'm going to make $1,900 if the stock does go higher to that 255 target. So again, this is why I reiterate, base your strategies based on where you think the stock's going to go. So if you think the stock's going to stay where it is, trade the credit spread. If you think the stock's going to go a lot higher, trade the debit spread. Use that as your gauge, because as the stock goes higher, as you can see, implied volatility has a relatively low impact to your overall P&L versus your debit, versus when the stock moves significantly higher, you get a much higher return on your investment if you do actually have that move in the underlying stock. So this is really where you can utilize our tool. You can set up any debit spread, you can set up any credit spread, put it side by side, and really allow you to say, where do I think the stock's going to go, and see exactly what the expected profit is, what the expected losses are if the stock goes against you. So as you can see, the stock goes, down to 230. Here I lose $2,000. Here I lose $1,500. So if the stock goes down to 230, I'm actually going to lose less money on this debit spread than I do on the credit spread. It's only if the stock goes all the way down to 216 am I going to lose that $2,000 on this debit spread. So this is really where you can really compare any two strategies side by side and see which one gives you the highest return and what your risk is overall if the stock goes against you. So this is really why we use this type of tool to help you understand each one of these strategies and look at them and compare them. That's really the most important thing, for you to understand what your risk is and what your rewards are before you get into a trade, so that nothing surprises you once you're in that trade. We hear a lot of customers that say, I bought a call and the stock went higher. I don't know why I lost money. And what we always tell people, use the P&L simulator. It really helps you understand what your potential reward is and what your risk is before you get into a trade, so that nothing surprises you. And the debit and credit spreads are really, really simple, because you have your max reward, you have your max risk. with the stock, and you know exactly where the stock needs to go to hit that max risk or where that max reward is. So it's nothing is a surprise to you after you get into a trade. So what I'll do is I can do one more example real quick before I open this up for Q&A. I was looking at, I forgot what stock I was looking at earlier. I had a good example. Anyone have any stocks that they want to look at? MU. Okay, let's take a look at MU. So Micron is certainly one of the high-flying stocks that have recently taken a huge hit recently, in my opinion, based on this stock. And I don't have an opinion on the stock per se, but looking at this chart right now, it certainly is a technical score of 5, so a neutral stock. But the trends are fairly bearish right now. The 6-month trend is mildly bearish. The 1-month trend is neutral. So I would certainly have more of a bearish bias on this specific stock. I certainly think there's a possibility that it's going to revisit this 52-week low, or not 52-week low, this relatively recent low around August 18th, around $46. So I would consider that a relatively quick move to the downside. Other people might disagree. Other people might feel that, this thing's recovered, it's bottomed already. It might start moving a little higher. So let's take a look at what happens if I was to trade a debit spread, meaning buying this October 12th, 45.53 put vertical. And then what we'll do is we'll say, what happens if we want to sell a short call, I'm looking for bearish, short call vertical against that. So let's look at that September expiration, which is 21 days from now. Let's look at a spread that's roughly $3 wide. So I'm looking to collect about $1. So let's move the strike so that I collect about $1, which will be, looks like there are, so the strikes here are a little difficult here because there are not the same number of strikes. So let's say 53.50. So the closest I can get is the 53.56, because after 56 is they go by $2.50 strikes. So not a great example here, but the 53.56 does collect me roughly a third of the distance. So I'm collecting 111 instead of 100. So let's actually compare those two strategies. So let's say I'm willing to risk, same thing, $2,500 on this trade. Here I can sell 13 contracts with the call credit spread. I can buy 8 contracts with the put credit spread. So again, if MU, which is trading at 52 right now, stays roughly where it is, again, the credit spread is going to be the trade that you're going to want to trade. So if your views are Micron's not going to move any lower, it's just going to stay right where it is, or maybe move a little higher, or maybe move just a little bit lower, you should definitely consider trading the credit spread. If you're in the camp where I think that the stock's going to easily go back to that 46 level and retest that support level, as you can see, 46. Here, as you can see, I'm going to make a $1,400 credit on my call vertical, but I'm going to receive a $3,300 profit on my put vertical. And we can compare dollar amounts here because I'm risking roughly the same dollar amount. So that's why I'm going to compare dollar for dollar here. So and we can use September 21st expiration as our, so as you can see on September 21st, if the stock goes down to $46, which is where it was just a few days ago, here I make a $1,400 profit on the credit spread, but I make a $2,200 profit on the debit spread. So again, based on your views on Micron, where you think it's going to go, that should be what you should use to dictate whether you want to take a look at the debit spread or the credit spread. And the goal of our tool is to allow you to put the two side by side. If you trade using the option chains, you can't compare a debit spread to a credit spread. Certainly can't do it side by side. And even if you could do these back of the envelope calculations on your own, really difficult to do them side by side. So that's really why we built this tool in this way, so that it allows you to compare the two strategies and really see which one's best suited for you. And once you're ready, click on the trade button. We have a full strategy checklist to make sure that you understand the risks of what you're trading. This particular one doesn't look particularly good because it's telling me I'm trading against the trend of a bunch of different things. But as an experienced trader, you can still decide to go ahead and trade that. But maybe as a new trader, you might not want to go against the trend on so many different things. So strategy checklist, really important for those that are brand new, making sure that you understand that. And once you're ready to place that trade, here is how you enter the strategy into your broker's platform. Just hitting that trade button will bring up all the details that you need to enter that into your trading platform. So with that, what I'm going to do is I'm going to open this up for Q&A. I want to thank everyone for taking the time out this afternoon and listening to our webinar. Just a reminder, make sure that when we send out the webinar, we will also include the links for you. So please make sure you look at some of the webinar recordings for those that are interested in learning more about credit spreads or debit spreads. We actually have specific webinars on that. And make sure you follow us on YouTube. That's going to get you access to a lot more of the webinars and the videos that we post on a fairly weekly basis. So with that, what I'll do is I'll open this up for Q&A. Any questions regarding anything I spoke about here today? I think I have a few questions here already. What are debit spread trades shown as ideas in the analysis page? But why are debit spreads shown as ideas on the analysis page but not credit spreads? Great question. The reason that debit spreads are shown as ideas is because debit spreads have a fairly or the best way to say this is that there's a fairly easy rule of thumb to figure out as to what are the optimal debit spreads to trade. That's not the same for credit spreads. Everyone has their own preferences when it comes to selling credit spreads. Some people like to sell really out of the far money credit spreads. Some people like to trade really wide credit spreads. Some people like to trade really narrow credit spreads. There isn't really a good rule of thumb when it comes to selling credit spreads. So that's why we always default to debit spreads. But in the debit spreads, generally speaking, are easier to manage, and they're useful for when you're expecting a move in one direction or another. Credit spreads are really for when you're fairly neutral on a stock, and we don't necessarily scan for those type of opportunities. All of our scans are for if you're bullish or bearish on a specific stock, so that's why we use debit spreads, because debit spreads are better for when you expect a move in one direction or another. Credit spreads don't give you that. They only, the maximum profit that you can get is a credit that you receive, and you're selling these out of the money credit spreads. So that's why we always default to debit spreads. Great question. How do you determine probability? Great question. So what we do is we first calculate the break-even price of each strategy. So for example, if I bought this put vertical, the break-even price is $50.16, which means Micron needs to go below $50.16 in order to be profitable. And that's how we calculate probability. We take the implied volatility in option, and we determine what is the probability of the stock being below that $50.16 based on the implied volatility of the option. So that's how we determine probability. Define reward versus profit. Not sure what you mean the difference is. So your reward is your profit, I think, if I'm reading that correctly. I'm not sure if you can clarify that question. I'm happy to answer that, but I'm not sure what you mean in terms of the difference between the two. Where can I see ADR and ATR on the chart for a stock? So we have, when you click on the expand button, there are studies. So if you're talking about ATR, which is average true range, you'll find that there. ADR is if I'm not mistaken, is under the directional movement system. Yep, ADX is there. So you have both under the study system, average true range and directional movement system for ADX. Do you consider open interest before a trade? No, we do not. What we do is we look at the spread between the bid and the ask price. So if you hit the trade button, we look at the spread between the bid and the ask price, and we give you liquidity based on that, because that's a much better indication of liquidity, which is probably what you're trying to gauge when you're looking at open interest, because those open interest only tells you if someone else traded it. It has nothing to do with the liquidity of something. Something could be very liquid, but no one has traded it. Especially when you have for example, on Apple, there's 1,200 strikes on Apple. What are the chances someone happened to trade the strike that you're looking for? But one strike's not any less liquid than the other. So we always use the spread between the bid and the ask price to determine liquidity, not open interest. How is the technical score of the stock determined? Great question. So we actually have a whole nother webinar specifically on this, and I highly recommend you to take a look at this if you're interested in directional views. But the technical score is a 6-factor technical model that we've developed that gives you an idea of relative strength across all 4,000 stocks or so that we rank stocks on. So we basically calculate a raw score of 6 different technical indicators across 3 different time frames for all stocks, and then we basically rank the stocks based on that raw score. And that tells us on a score of 1 to 10 what are the strongest stocks in the market and 1 are the weakest stocks in the market. Great question, Gary. Can you show me how to bring up SPY? I often trade the SPY and would like to compare credit and debit spreads on. So you just type in SPY and that's it. And it's the exact same thing. SPY is a big chain, so it takes a little longer to load. But you just type in SPY and that's it. So if you're bullish on SPY and you want to compare selling a credit versus debit spread, so let's take a look at SPY real quick. I'm going to bring up the stochastics. Just because that's one of the more popular indicators. As you can see, it's got a reading of 95. It's a very overbought stock. So maybe you are maybe you're bearish on SPY. I don't know what your views are, but you can use this to say, click on modify. You can either say I'm bullish and I want to sell a put credit spread, or you can say I'm bearish and I want to sell a call credit spread. And this will allow you to bring up the two. So let's say you want to look at a $3 wide spread. So you want to collect roughly about $1. So that means you can sell the, let's change the expiration dates too here. Let's look at the September 21st, right? So I'm looking to collect roughly about $1. This is a $3 wide. So here we go, 292, 295. That collects me roughly $1. That's $3 wide. So this is how I would analyze a credit spread versus a debit spread using SPY. When selecting strikes, how do we verify that a strike is liquid on the platform? Well, the chances you don't really know that, and no one really knows whether something is liquid or not. However, liquidity doesn't really differ from strike to strike. Liquidity differs from symbol to symbol. So SPY is going to be liquid regardless of what strikes that you trade, because a market maker determines liquidity based on how easily he can buy or sell that stock to offset his risk from making the market in that. So it doesn't vary from strike to strike. So if you're trading Goldman Sachs and it's liquid, it doesn't matter what strike you're looking at. So you don't have to worry about which strike is liquid and which strike is not. You just have to worry about the name itself. And usually they're pretty apparent, right? So if you're looking at a stock like Goldman Sachs, as you'll see, you usually get pretty good options play scores, and options play scores is usually a pretty good gauge of liquidity. So as you can see, a score of 74 is obviously not very good. 90 is a little better. But if, let's say, you're looking at some small cap name, as you can see, you get a very poor options play score of 0. This is telling you this is not a very liquid name when it comes to options. You should probably avoid it. So they become very obvious just by looking at the options play score. You don't have to worry about strikes per se. Do you prefer one platform versus another? I'm not sure what you mean by platform. I think you're referring to brokerage firm, and my answer is I don't think out of the top major brokerage firms there's a huge difference. I personally trade at TD, but that's just because I've been there for almost 15 years. I don't necessarily know that any of the major brokerage firms are that different from each other. I've certainly used, TD for a very long time, so I'm comfortable with them. But I don't particularly have one that I prefer over another. Do the comparisons work with Condors? Absolutely. So you can compare one Condor to another. So let's go back to Goldman Sachs for a second. If, let's say, you want to compare Condors, and I'm not a huge fan of trading Condors because Condors means that you expect the stock to stay exactly where it is, and I don't know any strategy or any analysis that you can do that can tell you, hey, I think the stock's going to stay exactly where it is. I like to think of Condors more so as a call and put credit spread combined, because if you think about an iron condor is really just a put credit spread and a call credit spread. And we just talked about, these strategies. Because when we're talking about having an iron condor, you can have an iron condor, but you generally don't want to enter it as an iron condor. You want to sell the put side when you feel that the stocks are oversold, and then you want to sell the call side when you feel the stock is overbought. not rarely do you feel that the stock is overbought and oversold at the same time, right? So that's why. But you can certainly use this tool. You can set up, all different types of condors. You can set up multiple iron condors and look at different expiration dates, different wings, and different widths. Or you can even compare a call condor to a put condor. So there's lots of different ways that you can utilize our tool. So a lot of people like to compare, put versus call condors, or one iron condor to another iron condor. But keep in mind, iron condors and call condors and put condors are really just constructions of two either debit spreads or two credit spreads together. So, and generally speaking, you don't ever find that a stock is oversold and overbought at the same time. So you either find it's overbought or it's oversold. So you want to leg in and out of these condors, in my opinion. If the cost of the trade and the reward is the profit of the trade equals zero? Not sure what you mean by that, Carl. If you could clarify with an example, I'd love to answer that question for you. Any other questions? Could you review iron butterflies in the same manner as you just did iron condors? Absolutely. So iron butterflies are the same as iron condors, just that the strikes are closer together. In my opinion, an iron butterfly and an iron condor are the exact same thing. It's just that you don't have a width, you only have wingspans. But again, if you think about an iron butterfly, it's really a call credit spread with the put credit spread, but the two middle strikes are the exact same strike. And my point is the same for iron condors and iron butterflies, is that each side of the trade is meant for different purposes. So you sell a put credit spread when you feel the markets are oversold, and you sell a call credit spread when you feel the markets are overbought. I don't know when you'll ever feel that the markets are both oversold and overbought, which is technically what you're doing when you're selling an iron butterfly. Iron butterflies is really a more volatility-based strategy, where you feel that there's a huge edge in implied volatility, and you feel that the markets are either going to, when you're short an iron butterfly, you basically think that implied volatility is going to collapse, and you feel the stock's not going to move anywhere. My only point is that I don't know of any analysis that I do that I can tell me that a stock's not going to move. So that's why I generally don't trade them. But hey, there's someone out there trades them, and someone probably makes some money trading them. Maybe they're smarter than I am. I don't know, but I haven't found a good way to trade iron butterflies or condors. I like to, if I ever trade them, I'm entering them as a separate trade. So I'll sell the put credit spread when I'm bullish, sell the call credit spread when I'm bearish. And sometimes those two things go from overbought to oversold very quickly. So you end up combining the two into an iron condor. In the GS example, the cost is 1,000, the reward is 1,000. So, no. The cost is 1,000, and that's your potential reward. So, for example, if we sold this, what did we say? We're bullish on Goldman Sachs, so we sold the what was this? September 21st. I think it was a $7 wide trade, right? Yeah, so we sold the 240 put, bought the 235 put, and I think what we said was we were willing to risk $2,500. So the stock stays exactly where it is. We make roughly about $1,000 profit. I'm sorry, 240. Yeah, so $1,200 profit. So the cost is negative $1,200. That's your reward. So the cost is the $1,200 credit is the reward that you get. So the actual gain is $1,000, not zero, Carl. The cost is a negative number, and that is the reward. Ken, thank you so much. I really appreciate this. I know many of you have seen some of our webinars before on similar type products, on similar type strategies. Again, we always try to bring something new every single time. This time was really talking about some of the back testing we've done for these strategies and where we find the optimal strikes are. So again, I really hope that you guys do find some new stuff with all of this. Alfred, I've already talked about open interest. We don't want to use open interest because open interest is not a good gauge for liquidity. We always use the bid-ask spread before, because when you hit the trade button, we tell you what the bid-ask spread is. That tells you what the liquidity is. Open interest is not a good gauge for that. What is the longest out one should look at when entering a debit spread? I don't necessarily think that there's a real limit to that. In reality, you could trade a 9-month debit spread. You could trade a 12-month debit spread. But if you're going that far out, I would suggest that you consider turning that that vertical into a calendar or diagonal, because you're not really getting the benefit of that short leg as much when you're going that far out. The short leg is meant to give you that short theta on that short leg. So when you're going that far out, you're not getting much theta at all on the short leg. So you would want to be long the long call or the long put, the 6 month or 9 month or 12-month long call or put, but you want to sell short dated options against that. So that's more turning your vertical into almost like a cover call. You're buying a leap and then you sell short dated calls or puts against that to offset the cost. So if you're going much further out than I would say 6 months, I would definitely consider turning that into a calendar or diagonal instead of keeping it a vertical. Susan, yes, this is recorded and all the slides are available to you. That will be sent out to you in about 30 minutes after we finish here. What about unusual activity, options activity, heavy call buying? What about unusual activity? How would you use that? Unusual activity is usually just telling you what someone else is buying, or you can try to infer what someone else is buying and selling. If you want to follow that, that's on your own behalf, but that usually has no impact on what we do here. Carl's saying, it seems standard to use 50 to 60 and 15 deltas for debit spreads. I've used 30, 35, and 15s as a hedge. Is there any back testing on these spreads? I have put a debit spread on now where I spent a net of 2.9 on a $2 spread on a $31 stock with a long leg. Hey, Carl, this is a very specific example, and I'd love to get into this, but there's a lot of stuff in that thing that you just wrote. So why don't you send me an email at info@optionsplay.com. I just typed in that email address. Why don't you send me an email specifically about this example that you're talking about, and I'd be happy to kind of review that. I don't know that it's the right place to do it on this Q&A session. Any other questions regarding any of the stuff that we discussed here today about a call and debit and credit spreads? And Andy, just to your point, when you're talking about heavy call buying, that just means someone else is very bullish on this, on a specific name. You can certainly follow that and say, hey, I'm going to tag along on this trade and not, but that really doesn't necessarily, translate into profits, based on some of the things that we've seen. But certainly it's an interesting thing to look at, in my opinion, but I don't know that that always translates into anything in particular. Can you look at Pandora? Sure, I'll pull up Pandora. What's your view on Pandora here? Pandora just broke out above that $8.50 resistance level. So certainly, if you're expecting a breakout and you think the stock's going to break out and move significantly higher, always the debit spread is certainly something. So certainly sounds like the stock has moved already off of that heavy call buying. So it depends on whether you think it's going to continue or not. If you think it's going to continue, I think the debit spread is the better trade to make. Chances are you might not even find a credit spread that's really great for this stock. So if we go out to September, let's just look at the $1 strikes here. So $1 strike, as you can see, I'm not even getting close to. I am getting close to a third of the width here. So if I sold this isn't in the money. So if I sold an out of the money put, you know, I sold the $9 put, bought the $8 put, I'm not getting close to that a third. So I'm really not collecting enough premium to take on the $78 worth of risk to try to make $22. In my opinion, not great risk to reward. So again, but a debit spread, as you can see, I'm risking $65 to try to make $135. If the stock goes up to, let's say, $9.50, excuse me, stock goes up to $9.50. Debit spread doesn't make me much money. Oh, it's already trading at $9.18. Sorry. So if it goes up to, let's say, $10. Here I make a $35 profit. Here I make a $22 profit, which is a 53% return. So it's really up to you. So the point of this tool is to show you guys how to do your own analysis and be able to be self-sufficient in looking at credit versus debit spreads. Any other questions? If the short option is reaching the point where it might be a sign, does it make sense to close that leg of a spread? If you're referring to a credit spread, absolutely. So this is where, William, why don't you send me an email at info@optionsplay.com? I'm happy to go over that specific example with you because I don't know if you're talking about a debit or a credit spread. So send me an email at info@optionsplay.com. I just want to thank everyone for taking the time out this afternoon. I hope you guys find this presentation useful. And please send us your feedback if you have any questions regarding anything. You can send it to info@optionsplay.com. I just want to thank everyone for taking the time out this afternoon. We'll send you the webinar and the recording with the slides in about a half hour. I hope you guys have a great afternoon, and I'll see you guys next Thursday.